Hi everyone! Today we're going to talk about one of the most important concepts in the market, higher highs and lower lows. This is a key topic because no matter which strategy you use, if you don't understand the market direction, you can't trade correctly. Higher highs and lower lows help us identify the main direction of the market and show us how to trade only in the right direction. But that's not all. By mastering this concept, you can build a simple, practical, and repeatable trading strategy for entering trades, which we'll break down step by step in this video. So if you want to see the chart like a professional trader, make sure to watch this video till the end. Left side of the chart, higher high, bullish trend. On the left side of the chart, we can clearly see a strong bullish market structure. Price first creates a higher high, then enters a pullback. But the most important point is this. Price breaks the previous high and a candle closes above that level. This candle close above the previous high confirms that buyers are in control of the market. As long as the market continues to form higher highs and higher lows, our focus should only be on buy opportunities. Now let's look at the right side of the chart. Here, the market structure changes and price starts forming lower lows and lower highs. Price breaks the previous low, and once again, the key point is a strong candle closes below the previous low. This candle close below the previous low shows that sellers have taken control of the market. Key educational insight. At this stage, what really matters is the strength of buyers or sellers during the break of a previous high or low. This strength can be identified by the power and momentum of the candle that performs the breakout. However, one rule is non-negotiable. A break without a valid candle close is not confirmed. It doesn't matter whether a high or a low is broken. We must always see a clear candle close above the high or below the low to consider the break valid.